Question 1. A registered representative at a FINRA member firm discovers through a confidential company report that a publicly traded company is about to announce significantly lower than expected quarterly earnings. The representative then advises a family member to sell their shares in that company before the announcement. This action would most likely be considered A. Permissible as the representative did not personally trade. B. A violation of the insider trading rules. C. An acceptable ethical practice if the family member is not a customer of the firm. D. A breach of fiduciary duty but not insider trading. Answer: B. A violation of the insider trading rules. This scenario describes insider trading, which occurs when an individual trades securities based on material, non-public information. The key elements are that the information is material, meaning it would affect an investor's decision, and non-public, not generally available to the public. Even though the representative did not personally trade, tipping a family member to trade on this confidential information constitutes a violation because the representative passed on material non-public information, benefiting from its disclosure by avoiding a loss. Always remember that sharing or acting on confidential corporate information for personal gain, directly or indirectly, is illegal. Question 2. Under FINRA Rule 5310, what is the primary obligation of a member firm regarding customer orders? A. To execute customer orders at any venue, regardless of price, if it ensures fast execution. B. To use reasonable diligence to ascertain the best market for the subject security and buy or sell in that market so that the resultant price to the customer is as favorable as possible under prevailing market conditions. C. To prioritize proprietary trades over customer orders if the proprietary trade offers a significant profit opportunity. D. To display all customer limit orders in the public quotation system without exception. Answer: B. To use reasonable diligence to ascertain the best market for the subject security and buy or sell in that market so that the resultant price to the customer is as favorable as possible under prevailing market conditions. FINRA Rule 5310, often referred to as the best execution rule, obligates member firms to achieve the most favorable terms reasonably available for their customers' orders. This means considering various factors like price, speed, likelihood of execution, and order size. The phrase, reasonable diligence to ascertain the best market, emphasizes the active responsibility of the firm to survey available markets and choose the one that provides the best possible outcome for the customer. Think of it as a firm's duty to shop around for the best deal for its clients, ensuring they get the most favorable price for their trades. Question 3. Which of the following is most accurately defined as a dark pool? A. An exchange market where only institutional investors can trade directly. B. A trading system that allows direct peer-to-peer trading without broker-dealer intermediation. C. An alternative trading system, ATS, that does not display its order book to the public. D. A segment of a public exchange specifically designated for after-hours trading. Answer: C. An alternative trading system, ATS, that does not display its order book to the public. A dark pool is a type of alternative trading system, ATS, that offers institutional investors the ability to trade large blocks of securities anonymously, without publicly displaying their orders. The dark pool refers to the lack of pre-trade transparency, meaning the order book and quotes are not visible to the general public. This anonymity helps minimize market impact for large trades. While ATSs are generally electronic trading venues, the defining characteristic of a dark pool is its non-displayed liquidity, contrasting with traditional exchanges that openly show their order books. Question 4. A market maker submits a significant number of non-bona fide orders to manipulate the appearance of supply or demand in a security, quickly canceling them before they can be executed. This manipulative practice is best described as A. Layering. B. Wash sales. C. Marking the close. D. Pump and dump. Answer: A. Layering. Layering is a manipulative trading practice where a market participant places multiple, non-bona fide orders on one side of the market, either buy or sell, at various price levels, with the intent to trick other traders into thinking there is significant interest or lack thereof at a specific price. These layers of orders are then cancelled before they can be executed, after a legitimate order on the opposite side of the market is filled, creating a false impression of market depth. This strategy aims to induce other market participants to trade at prices that are more favorable to the manipulator. This differs from wash sales, which involve no change in beneficial ownership, or marking the close, which manipulates closing prices. Question 5. Under FINRA rules, a firm's supervisory system must include written supervisory procedures, WSPs, that address all of the following, except A. The review of customer accounts and transactions. B. The approval of new accounts. C. The personal investment strategies of associated persons' immediate family members who do not work at the firm. D. The training of associated persons regarding their responsibilities. Answer: C. The personal investment strategies of associated persons' immediate family members who do not work at the firm. While firms must have WSPs covering many aspects of their business, including the review of customer accounts, new account approvals, and training of associated persons, they are generally not required to dictate or supervise the specific personal investment strategies of associated persons' immediate family members who are not employees of the firm. The focus of WSPs is on activities directly related to the firm's business and its associated persons. Firms have an obligation to monitor accounts where associated persons have control or beneficial interest, but not merely all family member accounts. Question 6. A registered representative placed an order for a customer without the customer's prior authorization, believing it was in the customer's best interest. This action is most accurately described as A. Discretionary trading, which is permissible if the customer gave verbal consent. B. Unauthorized trading, which is a serious violation. C. Front-running, which is prohibited. D. Churning, which is a type of excessive trading. Answer: B. Unauthorized trading, which is a serious violation. Placing an order for a customer without their prior authorization is known as unauthorized trading and is a serious violation of FINRA rules. Even if the representative believed the trade was in the customer's best interest, the lack of explicit consent from the customer for that specific trade makes it prohibited. Discretionary trading is only permissible if the customer has granted written discretionary authority to the representative, and verbal consent is insufficient for this purpose. Unauthorized trading is a clear breach of trust and regulatory rules. Question 7. According to SEC Rule 10b-18, a company repurchasing its own shares in the open market must adhere to certain conditions to gain a safe harbor from market manipulation charges. Which of the following is not a condition for this safe harbor? A. The purchases are made through only one broker-dealer on any given day. B. Purchases are not the opening transaction on any given day. C. The total volume of purchases on any single day does not exceed 50% of the average daily trading volume, ADTV, for that security. D. The purchases are made at a price no higher than the highest independent bid or the last independent transaction price, whichever is higher. Answer: C. The total volume of purchases on any single day does not exceed 50% of the average daily trading volume, ADTV, for that security. SEC Rule 10b-18 provides a safe harbor for issuers repurchasing their own stock, protecting them from market manipulation claims, provided certain conditions are met. One key condition for volume is that the total volume of purchases on any single day does not exceed 25% of the average daily trading volume, ADTV, for that security, not 50%. Other conditions include restricting purchases to one broker-dealer, avoiding opening trades, and limiting the purchase price. Remember, the 25% ADTV limit is crucial for the safe harbor, designed to prevent the issuer's buybacks from overly influencing the stock price. Question 8. A broker-dealer engaging in proprietary trading executes a significant block order for a highly illiquid stock. To reduce the risk of holding a large, potentially difficult-to-sell position, the firm immediately hedges its position by selling a corresponding amount of a related, more liquid security. This risk management strategy is best described as A. Market making. B. Arbitrage. C. Position hedging. D. Underwriting. Answer: C. Position hedging. Position hedging involves taking an offsetting position in a related security or derivatives to mitigate the risk associated with an existing position. In this scenario, the firm is holding a large, illiquid stock position, risk, and is reducing that risk by selling a more liquid, related security. This action specifically aims to protect the firm's capital from adverse price movements in the illiquid stock, rather than trying to profit from price discrepancies, arbitrage, or facilitate customer trades, market making. Always consider whether the action's primary purpose is to reduce an existing risk, which points to hedging. Question 9. Which of the following is the primary purpose of Regulation NMS? A. To establish rules for the registration of broker-dealers and their associated persons. B. To promote fair and orderly markets by enhancing competition and transparency in the U.S. equities markets. C. To regulate the offering and sale of municipal securities. D. To prevent insider trading and market manipulation in all securities. Answer: B. To promote fair and orderly markets by enhancing competition and transparency in the U.S. equities markets. Regulation National Market System, Reg NMS, was implemented by the SEC to modernize and strengthen the national market system for equity securities. Its primary goal is to foster competition among market centers and improve transparency and efficiency in the trading of NMS stocks. This is achieved through rules like the Order Protection Rule (OPR), the Access Rule, and the Market Data Rules, all designed to ensure investors receive the best available prices and have access to market information. Think of Reg NMS as the overarching framework designed to ensure fair play and optimal execution across fragmented equity markets. Question 10. A Series 57 registered person is engaged in proprietary trading for a broker-dealer. Which of the following would not be considered a primary responsibility of this individual? A. Ensuring best execution for customer orders. B. Managing the firm's capital allocated to trading activities. C. Adhering to risk limits established by the firm. D. Complying with regulatory rules related to trading, such as short sale rules. Answer: A. Ensuring best execution for customer orders. A Series 57 registered person primarily engages in proprietary trading, which means they are trading for the firm's own account. While all firm employees must generally understand regulatory compliance, ensuring best execution is a direct obligation to customers and falls more squarely on representatives who handle customer orders, example Series 7 registered persons, and the firm's overall supervisory structure. A proprietary trader's focus is on managing the firm's trading capital, adhering to internal risk limits, and complying with rules relevant to their own trading activities. Keep in mind the distinction between trading for the firm versus trading on behalf of customers. Question 11. Under FINRA rules, a registered person is generally prohibited from lending money to or borrowing money from a customer, except in which of the following circumstances? A. If the firm has written procedures allowing such loans and the loan is between immediate family members. B. If the customer is a bank or other financial institution in the business of lending. C. If the loan is for a de minimis amount and will be repaid within 30 days. D. If the customer has total assets exceeding $10 million. Answer: A. If the firm has written procedures allowing such loans and the loan is between immediate family members. FINRA Rule 3240 generally prohibits registered persons from lending to or borrowing from customers. However, there are exceptions. One exception is when the customer is an immediate family member of the registered person, provided the firm has written procedures allowing such loans and the loan meets specific criteria, such as being for a personal relationship outside of the broker-customer relationship. Other exceptions exist for banks or financial institutions and for situations based on a personal relationship where the loan is not based on the customer-broker relationship, but specific firm approval is still required. This rule is designed to prevent conflicts of interest and protect customers. Question 12. A broker-dealer executes a customer's order for 1,000 shares of XYZ stock. The firm immediately then places a proprietary order for 1,000 shares of the same XYZ stock on the same side of the market before the customer's order is reported. This practice is most likely A. Permissible if the firm's order is executed at a better price. B. Front-running, which is prohibited. C. Permissible as long as the firm holds the stock for more than 24 hours. D. A legitimate hedging strategy. Answer: B. Front-running, which is prohibited. This scenario describes front-running, a prohibited manipulative practice. Front-running occurs when a broker-dealer, or any person, trades a security for its own account, proprietary trading, based on advanced knowledge of a pending customer order of substantial size, to profit from the expected price movement that the customer's order will cause. The key elements are advanced knowledge of a customer's large, unexecuted order and trading for one's own account ahead of it on the same side of the market. This practice is unethical and illegal because it puts the firm's interests ahead of the customer's. Question 13. A FINRA member firm must establish and maintain a system to monitor and surveil for manipulative trading. Which of the following is an example of a manipulative trading practice that such a system would be designed to detect? A. A market maker posting a two-sided quote. B. An investor selling shares short based on negative public news. C. An algorithm placing and immediately canceling large orders to create false market depth. D. A broker-dealer executing an agency cross-transaction between two unrelated customers. Answer: C. An algorithm placing and immediately canceling large orders to create false market depth. An algorithm placing and immediately canceling large orders to create false market depth is a clear example of spoofing or layering, which are manipulative trading practices. These tactics are designed to deceive other market participants about the true supply and demand, thereby influencing prices for personal gain. A firm's surveillance system would be specifically designed to identify such patterns, as they distort market integrity and are illegal. In contrast, market makers posting quotes, investors selling based on public news, and legitimate agency cross-transactions are all part of normal, permissible market activity. Question 14. Which of the following best describes the Manning Rule, FINRA Rule 5320? A. It requires firms to handle all customer orders with discretion. B. It prevents firms from trading ahead of customer limit orders for their own proprietary account. C. It mandates that all trades must be reported within 10 seconds of execution. D. It dictates the capital requirements for market makers. Answer: B. It prevents firms from trading ahead of customer limit orders for their own proprietary account. FINRA Rule 5320, commonly known as the Manning Rule, is designed to protect customer limit orders. It prohibits a member firm that holds an unexecuted customer limit order from trading a security for its own account at a price that would satisfy the customer's order, unless the firm immediately executes the customer's order up to the size of the proprietary trade. This rule ensures that a firm does not profit from its knowledge of customer interest by stepping in front of their clients. It's about putting the customer first and preventing firms from jumping the line on their own clients. Question 15. All of the following are typically considered components of a broker-dealer's anti-money laundering (AML) program, except A. Appointment of an AML compliance officer. B. Training of appropriate personnel. C. Independent testing of the AML program. D. Direct reporting of all suspicious transactions to the SEC. Answer: D. Direct reporting of all suspicious transactions to the SEC. Broker-dealers are required to report suspicious transactions, but these reports are filed with the Financial Crimes Enforcement Network, FinCEN, by filing a Suspicious Activity Report, SAR, not directly with the SEC. While the SEC may investigate financial crimes, FinCEN is the central agency for receiving and analyzing financial transaction data for AML purposes. The other options, appointing an AML compliance officer, providing training, and conducting independent testing, are all essential components of a robust, compliant AML program. Always remember FinCEN is the destination for SARs. Question 16. Under Regulation NMS Rule 611, Order Protection Rule, which of the following scenarios would not be an exception to the requirement that a trade-through of a protected quotation is prohibited? A. The trade-through occurs as a result of an intermarket sweep order, ISO. B. The trading center displaying the protected quotation had experienced a failure, malfunction, or material delay that prevented execution of the order. C. The protected quotation was not immediately accessible. D. The order that traded through was a small, retail order less than 100 shares. Answer: D. The order that traded through was a small, retail order less than 100 shares. The Order Protection Rule, Rule 611 of Reg NMS, generally prohibits trading through a protected quotation, meaning a displayed quotation that is the best bid or offer from an exchange or ATS. However, there are specific exceptions to this rule. Exceptions include instances where the order is an intermarket sweep order, ISO, which is designed to simultaneously sweep all better-priced protected quotes, or when the protected quotation is not immediately accessible or the trading center displaying it is experiencing a technical malfunction. The size of an order, whether small or retail, is not generally an exception to the trade-through rule. All orders must respect protected quotes regardless of their size. This rule aims to ensure that investors consistently receive the best available prices. Question 17. A firm engages in matched orders or wash sales. These activities are prohibited primarily because they a. Fail to provide best execution to customers. B. Are considered a form of insider trading. C. Create a misleading appearance of active trading or price movement. D. Result in excessive commissions for the firm. Answer: C. Create a misleading appearance of active trading or price movement. Matched orders and wash sales are prohibited manipulative practices designed to create a false or misleading appearance of active trading or price movement in a security. A matched order involves offsetting buy and sell orders entered by the same parties to create the illusion of legitimate trading, while a wash sale involves selling and repurchasing the same security with no change in beneficial ownership. Both are illegal because they deceive other market participants by generating artificial volume or prices, making the market appear more active or liquid than it actually is. They are about deception, not necessarily commissions or best execution. Question 18. A registered representative with a Series 57 license is considering using a firm-sponsored access model. Which of the following is a key regulatory concern regarding sponsored access? A. It eliminates the need for broker-dealers to maintain net capital. B. It bypasses pre-trade risk management controls. C. It restricts the types of orders a firm can accept from clients. D. It reduces the speed of order execution, leading to poorer prices. Answer: B. It bypasses pre-trade risk management controls. Sponsored access allows a firm's customers or other entities to directly access an exchange or ATS using the firm's market participant identifier, MPID, bypassing the firm's own trading systems. A key regulatory concern with sponsored access is that it historically allowed orders to enter the market without passing through the broker-dealer's pre-trade risk management controls, which could lead to significant market disruptions or excessive risk-taking. Regulators have since imposed stricter requirements for pre-trade controls on sponsored access to mitigate this risk. Question 19. Under the Order Protection Rule, Rule 611 of Reg NMS, a trading center receiving an intermarket sweep order, ISO, must a. Not execute the order unless all protected quotations at better prices are satisfied. B. Ensure that all ISOs are executed at the National Best Bid and Offer, NBBO. C. Immediately execute the ISO without regard for protected quotations displayed at other market centers. D. Route the ISO to the market center displaying the best protected quote. Answer: C. Immediately execute the ISO without regard for protected quotations displayed at other market centers. The order protection rule generally requires trades to execute at the best available prices. However, an intermarket sweep order, ISO, is a special type of order that allows for immediate execution without regard for protected quotations displayed at other market centers. An ISO must be identified as such, and simultaneously, other ISOs must be sent to sweep all protected quotations at superior prices in other market centers. This allows traders to sweep the market and execute a large order across multiple venues quickly, but the sender bears the responsibility of simultaneous orders to satisfy better prices elsewhere. Question 20. A broker-dealer must maintain records of all communications related to its business for a specified period. According to FINRA Rule 4511, how long must most books and records be preserved? A. 2 years. B. 3 years. C. 5 years. D. 6 years. Answer: D. 6 years. FINRA Rule 4511 generally requires member firms to preserve most books and records for a period of 6 years. This rule is crucial for regulatory oversight and ensures that regulators can review historical trading activity, customer interactions, and financial records. While some specific records may have different retention periods, example 3 years for certain marketing materials, life of the enterprise for partnership agreements, the standard for most operational and customer-related records is 6 years. Remember that 6 years is a common retention period for many important records in the securities industry. Question 21. Which of the following statements about market makers is most accurate? A. Market makers are only obligated to quote prices when solicited by an institutional client. B. Market makers must always maintain a perfectly balanced inventory of securities. C. Market makers are required to maintain a two-sided quote, bid and offer, in the securities in which they make a market, during normal market hours. D. Market makers are exempt from all FINRA rules regarding order handling. Answer: C. Market makers are required to maintain a two-sided quote, bid and offer, in the securities in which they make a market, during normal market hours. A fundamental obligation of a market maker is to provide liquidity by continuously quoting both a bid, price at which they are willing to buy, and an offer, price at which they are willing to sell, for a particular security during regular market hours. This two-sided quote helps ensure an orderly and liquid market. While they aim to manage inventory, they don't necessarily maintain a perfectly balanced one, and they are certainly not exempt from FINRA rules. Their role is to facilitate trading by standing ready to buy or sell. Question 22. Which of the following activities is not permitted under the safe harbor provisions of Section 28(e) of the Securities Exchange Act of 1934, soft dollar rule? A. Paying for proprietary market research used by the broker-dealer's internal traders. B. Paying for third-party research reports that assist the money manager in making investment decisions. C. Paying for order execution services provided by a broker-dealer. D. Paying for a Bloomberg terminal used by a portfolio manager to gather market data. Answer: A. Paying for proprietary market research used by the broker-dealer's internal traders. Section 28(e), often referred to as the soft dollar rule, provides a safe harbor for investment managers to use client commission dollars to pay for research and brokerage services that benefit the client. However, this safe harbor explicitly applies to products and services that assist the money manager in making investment decisions for client accounts. Paying for proprietary market research used by the broker-dealer's internal traders, for their own account, does not fall under this safe harbor because it does not directly benefit the client for whom the commission was generated. The rule focuses on the benefits received by the client through the manager's investment decisions. Question 23. A broker-dealer executes a large order for a customer and then publicly announces the trade on a chat forum before it has been reported to the tape. This action is most likely a violation of A. The Manning Rule. B. Trade reporting rules. C. Best execution requirements. D. Short sale rules. Answer: B. Trade reporting rules. Publicly announcing a trade before it has been reported to the tape, the public record of transactions, is a violation of trade reporting rules. FINRA and SEC rules, such as those related to ACT and TRACE, mandate that trades be reported promptly, example within 10 seconds for equity trades, to ensure transparency and prevent information asymmetry. Premature disclosure, even through informal channels like a chat forum, undermines market integrity by disseminating non-public information about executed trades before it is officially available to all market participants. This is a common way information leakage can occur. Question 24. A registered securities trader has an obligation to maintain currency in their knowledge of relevant FINRA rules and federal securities laws. Which of the following is a mandatory component for maintaining a Series 57 registration? A. Completing a minimum of 40 hours of continuing education annually. B. Participating in the firm element and regulatory element of continuing education. C. Retaking the Series 57 exam every 3 years. D. Passing a new examination for each significant rule change. Answer: B. Participating in the firm element and regulatory element of continuing education. All registered persons, including Series 57 holders, are required to fulfill the continuing education (CE) requirements, which consist of two components, the regulatory element and the firm element. The regulatory element is a computer-based training program administered by FINRA, typically taken at the 2-year anniversary of registration and every 3 years thereafter. The firm element requires broker-dealers to provide annual training to covered registered persons on products, services, and regulatory updates relevant to their business. This ongoing education ensures traders stay current with industry rules and best practices. Question 25. An agency cross-transaction occurs when a broker-dealer A. Trades as principal with a customer on both sides of the transaction. B. Acts as an agent for both the buyer and the seller in the same transaction. C. Executes a buy order for one customer and a sell order for another customer, without acting as principal. D. Facilitates a block trade between two institutional clients through an exchange. Answer: C. Executes a buy order for one customer and a sell order for another customer, without acting as principal. An agency cross-transaction occurs when a broker-dealer acts as an agent for both the buyer and the seller in the same transaction, effectively matching a customer's buy order with another customer's sell order. The key aspect is that the firm does not take a principal position, i.e., it does not buy the securities into or sell them from its own inventory, but merely facilitates the trade between two distinct customers. While permissible, such transactions require specific disclosures and consent from both parties to address potential conflicts of interest.